My name is Dr. Felicia Levy. Let's talk about financial risk and return. So what is the relationship between risk and return? Well, the rate of return that investors require for an investment depends upon the risk associated with that investment. The higher the risk, the more the investor expects to be compensated for taking that risk. The rate of return is what you earn on an investment in percentage terms. Think of risk as a measure of how certain you are that you will receive a particular return. A higher risk means you are less certain. Okay, so now we've established that a higher risk requires a higher return. But how do we measure those returns? The first measurement is the total holding period return. This is the return on an asset over a specific period of time or holding period. The holding period return consists of two components, capital appreciation and income. Capital appreciation is the change in price of the assets over the holding period. Income is what an investor receives from the assets while they own it. We can find the holding period return by adding the change in price plus the cash flow over the initial price. The second measurement is the expected rate of return. This is the rate in percentage terms that an investor expects to receive. To calculate the expected rate of return, we will use the probabilities that an outcome will occur. Here, we see that the expected return on an asset is simply the weighted average of possible returns on the asset, where the returns are weighted by the probability of their occurrence. Let's walk through an example. Here, there are three possible outcomes: boom, normal, and recession. Each outcome has been assigned a probability and a return. To find the expected return, we multiply the probability of an outcome times the return of the outcome. We then sum the results to determine the expected return. Now let's look at how we might compare two assets with the same return. How can we determine which asset to purchase? We learned earlier how to calculate the expected return of each outcome, and we see that both stocks end up with an expected return of 5%. But if you dive into the specifics of the outcomes, you'll see that while the good outcome is positive for both stocks, the bad outcome has very different outcomes. The investor then has to ask themselves, what is their level of risk tolerance? Are they comfortable with the idea that if a bad scenario occurs in stock B, they will lose money? If they're not comfortable with this idea, then they should choose stock A. But as you can see, the good outcome for stock A yields less than half the return of the good outcome for stock B. We turn next to a discussion of the two most basic measures of risk used in finance, the variance and the standard deviation. Variance is a measure of uncertainty associated with an outcome. It tells the investor the range of possible outcomes. This slide illustrates the computation of variance. Variance is represented by sigma squared. Variance squares the difference between each possible return and the mean return, then multiplies each squared difference by its associated probability before summing them. Standard deviation is the square root of variance. It tells us about the risk. In general, risk is a measure of the range of possible outcomes. Standard deviation tells us the probability that an outcome will fall a particular distance from the mean or within a range. An investor can use this information to determine if an investment falls within their comfort level of risk. The larger the standard deviation of a return, the riskier the investment. Returns on a single asset are risky. You have all your money in one investment. If that investment does not perform well, you lose money. To mitigate this, you need to diversify your investments. Invest in multiple assets. This could be multiple stocks or a stock index. It could be a portfolio of stock and bonds, or you could add real estate to the mix. When thinking about risk and diversification, the idea is to create a portfolio of stocks that work well together. This usually means that a portfolio should hold stocks that move in opposite directions. If a portfolio only holds stocks that move in the same direction, the portfolio will do very well in uptimes and very poorly in downtimes. Let's think of an example. In June 2022, consumer discretionary stocks like eBay were down around 35%. Communication services stocks were down about 32%, and information technology stocks were down about 30%. In contrast, energy stocks in the S&P 500 were up about 39%. Having energy stocks in your portfolio could help offset the losses from having information technology stocks in your portfolio. Returns for individual stocks from one day to the next have been found to be largely independent of each other and approximately normally distributed. In other words, the return for a stock on one day is largely independent of the return on that same stock the next day, 2 days later, 3 days later, etc. So if you have a single asset, how could you determine how it performs compared to another single asset? The answer is the coefficient of variation. This measures the risk associated with a single asset or investment for each 1% of expected return. This allows a comparative analysis similar to the comparative analysis ratio that you calculated in Project 1. The higher the coefficient variation, the riskier the investment because the investor is taking on more risk per unit of return. Now, while the comparative analysis makes sense, there's a problem. Investors expect to earn a positive return even when assets are risk-free. Remember, risk-free assets are government securities such as treasury bills, notes, or bonds. If investors can earn a positive risk-free rate without bearing any risk, then it really only makes sense to compare the risk of the investment with the return that investors expect to earn over and above the risk-free rate. Therefore, a modified coefficient variation exists, which subtracts the risk-free rate from the expected return when calculating the coefficient variation. The inverse of the modified CV is the Sharpe ratio. It tells the investor the ratio of excess return over the risk-free rate to the standard deviation. It gives the investor the value of excess return per unit of risk. The higher the Sharpe ratio, the better the portfolio, since the investor will receive a higher mean excess return per unit of risk. We discussed earlier the importance of diversification. Therefore, it's not reasonable to only be able to calculate the risk of a single asset. A more realistic scenario is to compute the portfolio risk. Notice that this formula is just like the expected return formula for an individual stock. However, in this case, instead of multiplying outcomes by their associated probabilities, we are multiplying expected returns for individual stocks by the fraction of the total portfolio value that each of these stocks represents. So now we have the expected return for the portfolio. How do we quantify the risk associated with it? One of the challenges of computing portfolio risk is that rarely will the price of the stock in a portfolio change by the same amount across the portfolio. The price of each individual stock will change a different amount. Some stock prices will change upwards, and others might change not as much upwards or even downwards. When stock prices move in opposite directions, the price change of one stock will be partially offset by the change in another stock. Therefore, the level of risk for a portfolio of more than one stock is less than the average of the risks associated with the individual stocks. This means we cannot calculate the variance of the portfolio containing two stocks simply by calculating the weighted average of the variances of the individual stocks. We have to account for the fact that returns on the different shares in the portfolio tend to partially offset each other. So how do we do that? We use the covariance. The covariance of returns measures how the returns on two assets move together. Notice that the covariance calculation is similar to the variance calculation, but instead of squaring the difference between each possible return and the mean return value for an individual asset, we calculate the product of this difference for two different assets. Let's walk through an example. Let's find the covariance between the returns of stock A and stock B. We are given three outcomes: good, fair, and poor, and their associated probabilities and returns. We start by calculating the variance. We find that the variance for stock A is equal to 0.2503, and the variance for stock B is equal to 0.0411. Now that we have the variances, we can compute the covariance. The covariance of two assets is equal to the probability of each economic state multiplied by the difference of the return for each asset for each economic state minus the expected return for that asset. In our example, we see that the covariance is equal to negative 0.0995. But what does that value really mean? Just as it is difficult to directly interpret the variance of returns for an asset, it is difficult to directly interpret the covariance of returns between two assets. We get around this problem by dividing the covariance of returns by the product of the standard deviations of the returns for the two assets. This gives us the correlation between the returns of those assets. For our example, the correlation is negative 0.9810. Correlation is used to describe the relationship between two variables. The correlation between the returns on two assets will always have a value between -1 and +1. This value can have four outcomes: positive, negative, exactly 1, or 0. A negative correlation describes the extent to which two variables move in opposite directions. For example, if we have variables x and y, an increase in x is associated with a decrease in y. In the example we've been working, our correlation is negative 0.9810. This tells us that when stock A increases, stock B should decrease. A positive correlation means that when the return on one asset increases, the return on the other asset also tends to increase. A correlation exactly equal to +1 means the returns of the two assets are said to be perfectly positively correlated. If x increases by 5%, then y increases by 5%. The last outcome is a correlation of 0, which means that the returns on the assets are not correlated. In this case, the fact that the return on one asset is positive or negative tells you nothing about how likely it is that the return on the other asset will be positive or negative. Now that we know the relationship between the two variables, we need to understand how strong the relationship is. The relationship between the variables gets weaker as the correlation approaches 0. In our example, our correlation is negative 0.9810, which is much closer to -1 than 0. Because the correlation is far from 0, it indicates that there's a strong negative relationship. If the correlation had been negative 0.30, it would indicate that there is a weak negative relationship. On the positive side, a positive 0.30 would indicate a weak positive relationship, and a positive 0.9810 would indicate a strong positive relationship. Investors can diversify away risk unique to individual assets, but they cannot diversify away risk common to all assets. They cannot eliminate systematic or market risk. With complete diversification, all unique or unsystematic risk is eliminated from the portfolio. However, the investor still faces systematic risk. So let's talk about systematic risk and why it's important. For every stock, there are two types of risk associated with the stock. Unsystematic risk is the risk that can be eliminated. This is the diversifiable risk. Systematic risk cannot be eliminated. Unsystematic risk is also known as company-specific risk. It can be caused by things such as lawsuits, strikes, successful and unsuccessful marketing programs, winning or losing major contracts, or other events that are unique to a specific company. These events are random, and their impact on a portfolio can be eliminated by diversification. Bad events in one company are offset by good events in another company. Systematic or market risk stems from factors that impact all firms, things like war, inflation, recessions, or high interest rates. Since all stocks will tend to be negatively affected by these events, systematic risk cannot be eliminated by diversification. If systematic risk is all that matters when we think about expected returns, then we cannot use the standard deviation as a measure of risk. The standard deviation is a measure of total risk. We need a way of quantifying the systematic risk of individual assets. We can use regression analysis to quantify systematic risk. We are trying to determine the impact to a stock given the movement of an index. If the index goes up, does the stock go up, and if so, by how much? This is the same correlation concept that we discussed earlier. However, before we were discussing total risk. Now we are looking at individual stock risk. Now we want to identify if there's a correlation between a stock and a market index, such as the S&P 500, the Russell 2000, or the Dow Jones. Conducting a regression analysis is beyond the scope of this course, but when you conduct a regression analysis, you start by plotting data points for the stock and the market index on a graph. In using regression analysis, you can find the line that fits the data best. Once you have that line, you're able to compute the slope of the line, or beta. This example shows that the monthly returns on GE stock are positively related to the returns on the S&P 500. In other words, the return on the GE stock tends to be higher when the return on the S&P 500 is higher, and lower when the return on the S&P 500 is lower. The line that is created best represents the relationship between the monthly returns on GE stock and the returns on the S&P 500. The slope of this line, which equals 1.61, indicates that the return on the GE stock tends to equal about 1.61 times the return on the S&P 500. The slope of that line is called beta. In our example, beta was 1.61. This tells us that the volatility of the returns on the GE stock is 1.61 times as large as that for the overall S&P 500. We can apply the concept of beta not only to an individual stock, but also to a portfolio of stocks. The beta coefficient of a portfolio of stocks is the weighted average of the individual stock betas. Thus, because a stock's beta measures its contribution to the riskiness of a portfolio, beta is a theoretically correct measure of the stock's riskiness. Now that we've identified the measure of risk that diversified investors care about, systematic risk, we can now look at how this measure relates to expected returns. When you invest in a government security, you're investing in a security that has no risk. Government securities such as T-bills, notes, or bonds have no systematic risk. Returns are viewed as risk-free. We know that investors want to be compensated for the difference between the risk-free rate and the riskiness of an investment, that they need to be compensated for variations in asset risk, and that they also need to be compensated for the volatility of an asset compared to the overall market. Earlier, when we talked about the coefficient of variation and the Sharpe ratio, we stated that the expected return over and above the risk-free rate is the return that investors expect to earn for bearing risk. This is the compensation per unit of systematic risk. Then we end up with the relationship between risk and expected return, or the capital asset pricing model. The security market line illustrates what the capital asset pricing model predicts the expected total return should be for various values of beta. The actual expected total return depends upon the price of the asset. We can see how the SML is used in practice. If an asset's price implies that expected return is greater than that predicted by CAPM, that asset will plot above the SML line, meaning it is undervalued. Investors consider undervalued stocks to be selling at a price below their assumed intrinsic value. When the price rises to the intrinsic value, the investor will make a profit.